Thanks, Casey, for the kind introduction. And I'm sorry I can't be with everyone in Edinburgh today, but I thought I'd see if I can offer a few comments off the top that might help spark a debate and frame some of the discussion. Now, first of all, when we look at sustainable investing, I think it's helpful to get out of the weeds a little bit and zoom out. Take a 500-foot view of what have we achieved, and where do we need to go? What do we need to achieve? I think if we start, overall so far for society, I think it's important that we start with the results are obviously not, up to par, right? I would say that probably the biggest intervention to reduce emissions this critical decade came out of an animal market in Wuhan. And so really we need to be doing a lot more. And yet today we also see that sustainable investing is growing at breakneck speed, right? So ESG words are going up, ESG assets are increasing, bank profits are increasing, bank ESG profits are increasing, and they're all increasing alongside like emissions, not to mention inequality and a bunch of other things that they're meant to affect. So it doesn't really seem to be working at a societal level in the way that we want it to. And I would add that doesn't just create risks for the planet, it also creates all kinds of political instability. I'm 43 and the data shows that the majority of the people younger than me no longer believe in capitalism, right? So there's a challenge where an intergenerational wealth transfer is going on that creates a lot of political instability, and I would add adds urgency to what we're doing. So one of the things I'd say at the top to frame this is that often I'll hear people say, oh well, the ESG space needs reform, but give it more time, it's going to get there. And I think we have to also accept that there's a bit of privilege in the ability to make that argument, because I don't think that an 8-year-old girl in Bangladesh would sort of say, hey, give it more time, or in Pakistan, I would say give it more time right now. And there is, at its core, a lot of what's going on with climate change increasingly looks, I would tell you as a former insider in the industry, a little bit less like we're all making a collective mistake and a bit more like a heist, because the delay isn't just amplifying the costs of everything, but they're also transferring them to the youngest, the poorest, and the darkest skinned people in the world. So, the urgency that we need to fix this, we have to accept that urgency should be as if the planet were sitting at the table and all the planet is going to care about is emissions, not statements, not all kinds of other things. It only cares about the end results and the outcomes. Now, when we start off by talking about, are we serious about this? I think there's a few areas that I want to zero in on. There's a lot of good stuff going on, and I'll come to that later. But a lot of things I think we have to have tough discussions about. The first I would say is this persistent idea that divestment has some value. I have to be honest, I think divestment is a waste of time. Please debate it, everybody, but we've been trying it for decades. It has reduced not one bit of emissions. Literally, you can't draw a link between any of it. The chain through which it happens is illogical from a finance perspective, because you sell a share of a publicly traded company, you don't deprive the company of capital. Someone else just buys the share. Arguably, more and more people are saying this is actually like an active waste of our time, because we're applying cancel culture to financial markets, and it almost acts as a placebo because it doesn't really affect their financing the way we think, and it certainly doesn't affect emissions. Another thing that's really important to focus on is that not all sustainable investment dollars are created equal, right? So you'll see someone saying $500 billion in sustainable funds. That doesn't connect to the estimates for the trillions of dollars that we need to decarbonize, largely because a lot of these sustainable funds are just public markets ETFs that are reconstituting a different basket. So you get a little bit of a greener basket to sell a socially responsible person for higher fees. That just means the other basket's a bit browner. It's probably bought by a hedge fund like the one I started my career at. In the end, there's no gains to society. There's paper gains, right? So people can feel great about the fact that they have less emissions on paper, but it doesn't change anything in the real world. And the challenge is that these funds actually often use soft divestment, right? So $500 billion of ESG ETFs that just tilt, 10% in a certain direction to underweight fossil fuels. In general, it's so maybe $50 billion worth of divestment. One challenge, I think, is that because the climate community has often, sort of pushed for divestment, Wall Street eagerly built a whole bunch of funds based on that premise. The majority of sustainable funds today are actually based on that premise. They're either screening or out areas or tilting. So that doesn't seem to work, and unfortunately that's how the majority of public market ESG funds are are traded, and that creates this incongruence between the money we need and these great numbers in the ESG space that don't seem to be really connecting. Another important point to make is the importance of transparency, right? We hear a lot about disclosure and transparency. I would tell you, I think that's good in the sense that what isn't measured isn't managed, but it's key that we remember that it's necessary but not sufficient, right? I use a lot of sports analogies in much of the writing I've done, including a paper many of you have probably seen called The Secret Diary of a Sustainable Investor. And in that, I use sports analogies, competitive markets like competitive sports. So I'll use a soccer analogy here. If you just have disclosure alone, it would be like having video-assisted referee or VAR in a Premier League game, but then without the referee to give out a red card, right? Disclosure alone won't fix anything unless we're banking our efforts on a free market self-corrects thesis, which I suspect we're not because it's the greatest market failure in history. So disclosure is a piece of the puzzle, but it isn't enough on it in and of itself. And I think it's important to point out because there's a growing view that financial institutions are very happy to do disclosure, as the answer for the next few years to avoid, shall we say, internalization of externalities in economics or a price on carbon or other things that our experts tell us we need, but often isn't even possible to implement, in large part because of political spending and lobbying from the very same financial institutions who commit to wanting to address this crisis. The final point I'd say is the climate risks, right? We hear a lot about climate risks. That's really interesting and important, but if you're looking to fight climate change, that's not where you should be spending your time. Protecting a portfolio from the effects of climate change is not the same thing as stopping climate change from happening in the first place. To give you a sense, I have a friend in Miami, Carlos, who was looking to buy a house there, and he once told me, he said, listen, you've been working on climate risks, that makes me more comfortable, buying here. And I didn't know how to break it to him. I said, listen, Carlos, we're not trying to stop Miami from getting smacked by climate change. We're trying to get our money out before it hits. That's not the same thing. And I think it's important from a financial strategy perspective, but I don't think it really deserves a halo effect or really is, should be conflated with stopping climate change in the first place, which I think is the goal, or mitigating, which is the goal of a lot of people. Now, when you stop and think, okay, well, here are a bunch of things that are sort of working their way through the system, unfortunately not as fast as we would have liked, where do we need to go? And I think, number one, I think we need to have a significant and a strong commitment to sustainable products that have very clear additionality. If they have additionality, meaning that you investing in it creates something additional to the world that would not have otherwise occurred, we should encourage them. The unfortunate reality is that the majority of sustainable funds today do not have additionality because they work in the public markets, and generally speaking, the mechanism for creating any kind of behavioral changes is minimal, at least through not owning shares or buying shares, again, which already traded in markets. But there are a lot of great funds, private equity funds, VC funds, the type that are private, they're long-term, they invest fresh capital for an entrepreneur, right? So they're actually, you're not just changing hands of shares already in the market, you're actually providing new capital. That is to be encouraged, right? Because that allows us to fund the kind of innovators and scale the innovations we need. And it's not what is the public market stuff, which frankly looks a lot to me like just sort of moving money around, often to, make people feel better and or, increase fees. So private vehicles like that do have additionality. I think in the public markets, it is possible, but it's more along the lines of engagement and activism. So I think activist, strategies, even public activist strategies actually can help if they're done correctly. As a side note, I don't think it works against an oil company, but it does work for companies that are in between and can make a push in a direction within the confines of the legal obligation of fiduciary duty. That obviously doesn't work if your core business model harms society, because realistically you're not going to do voluntarily what society needs, and that's going to require regulation. So you have a bunch of funds of the type that are a small percentage, frankly, of what's today. We need more of those. The second thing is we have to understand that sustainable funds can't answer the question any more than we could flatten the COVID curve, a systemic crisis, by having a few people wear masks, right? This is systemic. We need everything to work and be green, and a few sustainable funds can't challenge a tidal wave moving in the opposite direction unless we can actually do something about that tidal wave of the overall industry. And I think for that, really, there's two things I think that are big focus areas of what we can do. I think number one, more aggressive engagement, shareholder engagement, based on the idea that, fiduciary duty doesn't just mean that you should be focused on, specific company by company. If you're actually a pension fund or an asset owner that has a very long-term focus in line with your beneficiaries, you don't want that intermediation that's happening sort of within the structure through asset managers where suddenly the time horizon shrinks because of the incentives. You actually want to take a long-term approach. You want to understand that systemic risks are something you're going to own anyway. And I think this idea of universal ownership and engagement on that basis is critically important because it allows shareholders to actually have a bit more of a push to get companies not to just sort of be squeezing out quarterly returns and polluting here and there, but actually doing something that that isn't endangering the broader system. Secondly, I think it's important though also that we realize that with certain companies you can engage, right? I don't think it makes any sense at all to try to get on the board of or even to have as a mechanism, one by one proxy fights against fossil fuel companies as if it's like a game of whack-a-mole to get them to do the right thing. Honestly, I mean, in the 50s when it came to, tobacco and we all figured out smoking causes cancer, the answer wasn't one by one proxy fights. The answer, of course, was regulation. There's the reason governments exist. And not for nothing, a Yale study showed that 8 million lives were saved in the US alone because of the regulation of cigarettes. Today, we need to understand that the most important things that we're going to do to drive systemic change are actually going to require mandatory systemic regulations, including to force companies to do things that are often not in their own interests. And not for nothing, there's a study in 2018 that showed that publicly listed companies impose net environmental and social costs of 2.2 trillion annually. It wasn't reflected in their reporting, but that's more than 2.5% of global GDP and 50% of the profits reported. So companies have to make hard choices, right? And they're not always going to do them voluntarily because they're not aligned with what's profitable for them. And I think that's why we attempt to regulate. And it's important we understand there's much we can do as shareholder engagement and so on that is better than divestment. But unless we live in a free market self-corrects world, it's not just divestment and engagement. It's obviously regulation. And I think it's very important for people in the industry to be very honest about that. Because if we're not being honest about that, we're actually disadvantaging our own younger employees, right? Because they gain the least from the system and the most at the risk of the consequences of inaction. And I think the last thing we want to see are value transfers going from junior employees to CEOs, which is, in some sense, what is probably happening. Because we have a short-term economic system with incentives set up that CEO pays the highest it's been in decades, its CEO tenure is the shortest it's been in decades. In a system like that, very often the short-term incentive is not actually to make long-term investments to be sustainable and green. It's actually to market yourself as doing that and kick the can down the road. All that being said, when we look at the ESG space, I think we need to separate two categories of things. Looking forward, we have some things that are great, right? I think it's great if we have better tools to measure things. It's great if we have effective standards so that data is reported apples to apples. I think it's fantastic the fact that there's a lot of human capital coming into the space, especially young people, right? Very, very motivated and passionate about this. So those are all great ingredients. In the future, I think they need to be combined in ways that have better products and better narratives. The products need to have additionality because in the worst instance, if all they do is market themselves as green but move money around for higher fees, it's not just dishonest to the people buying them. It's even worse, I suspect it acts as a placebo. And so a study I worked on showed actually that people are less likely than to support regulation if they feel like they've done something, especially if they're paid a bit more for it. So we don't want products that don't have any additionality because that's not going to help us solve the problem. And I think, the second thing that we have to focus on are the narratives, right? Sports have rules and referees. So does capitalism. The referees we've known what's needed to be done for climate change for decades. Right? These are systemic regulations to protect biodiversity, protect the climate, reduce emissions, so on and so forth. We don't tend to see those happening in large part because the narrative is not clear that this is a sport that's gone dirty. We need the refs to come in. The regulators need to actually do something. And often that's because the waters are intentionally muddied. And so I think it's very important for people in the industry to be very, very clear about the fact that there's stuff we can do around engagement, around products and so on, but a systemic solution is going to be required just in the very same way that for COVID, you couldn't flatten the systemic curve by some people doing the right thing. Everybody had to That's why government stepped in to flatten the curve. And if you take the lessons from COVID and apply them to climate change, there is actually a playbook to flatten the curve and to invest, as Operation Warp Speed did for vaccines, in solutions. And it's so simple, actually. I wrote a 5-minute micro course using memes that you can find on fixtherule.org. It's an open thing that explains, literally using memes and animated GIFs in 5 minutes, how what we just did in COVID could be applied to climate change. The biggest difference between COVID and climate change, the timeline. If the incubation period's a few weeks, it's inside the incentives of most of the leaders in the industry, and they'll act. If it's outside of the incentives of the players in the system, because it's decades out, they're probably not going to act in the way we need them to as a society. And that is precisely why it's going to require hard choices and regulation and sacrifice, right? It might, burgers might cost a little bit more. Maybe you're so old your vacation, but those are the hard choices we need to make now that'll pay off in the future, and that are the minimum that we can do for younger generations today to protect both the planet and the system. All that being said, I hope that everyone has great discussions today, and I hope I've managed to provoke some ideas that can guide it. And thank you for listening to my remarks, and have a great conference.